Joining us now is Oaktree head of liquid performing credit, David Rosenberg. Oaktree has $192 billion under management. It's good to see you.
Thanks for having me.
Welcome. How do you see this current cycle of rates and whether we've sort of reached the top?
You know, I think the key here really is a lot of people have this conversation. We're into this new normal of rates, and our chairman has made this comment a lot that this really isn't the new normal. He likes to call it the old normal, the abnormal part being zero interest rates that just lasted over 10 years and everyone got used to it. Rates at this level are, if you go back long enough, normal. So this whole narrative that they have to go back to where they were just isn't true. They can go back to where they were with a catalyst, but without the catalyst, they could stay roughly where they are for some time.
Isn't the catalyst that the Fed will start cutting?
Well, the question is, why does the Fed cut? And everybody's been waiting for this Fed pivot. And what I remind people is that the Fed cuts, something bad has to happen to justify a Fed cut. So I have this conversation all the time where I say the Fed's not necessarily in the business of propping up the stock market as much as everyone wants that to be true. And so you need something bad to happen. And if the economy is going the way it's going and earnings are going the way they're going, there's really no need to aggressively cut rates right now.
So have we erased the whole Waller from November idea that you could cut into strength over time, slowly?
I think we're starting to, yes.
Really?
I think the market's starting to kind of accept that. And I think the market's starting to kind of look at, especially within credit, the fact that you can earn some very attractive yields now. And if rates stay roughly where they are, there's some money to be made.
If rates stay where they are, do you expect defaults to pick up?
I do think that's going to be an issue. I like to say we're going into a credit picker's market, which hasn't been true for a long time, frankly, because whenever there was a mistake made, if you waited long enough, the Fed would bail you out. I think now, if rates stay where they are, you get to earn more, but that means companies have to pay more. And there are going to be some companies that can do it and some that are going to struggle.
What do you think their reaction function would be to a creep up in things cracking? Would there be a put?
I think that if you see fundamental weakness, I think there'll be a put. I think without the fundamental weakness, I think that the reality is, some companies are going to do okay. Some investors are going to have to kind of wear the decisions they've made.
Have you been surprised at how resilient the credit market has been throughout this cycle?
I've been very surprised, especially when you look at the consumer. Think about the market and what's propping up this market fundamentally is the consumer has been shockingly resilient in its ability and willingness to spend money. And, you kind of think about COVID savings, which, we all know were finite, certainly have lasted a lot longer than people thought. But we're kind of getting into a point where I would have expected consumer spending to slow down, and it still seems to be charging ahead.
Although with labor strength and home equity and stock market returns, why would it be surprising that they continue to spend?
I think it's at the rate that they're spending, right? And so I think that at some point you can only borrow for so long to keep spending and you're starting to see credit card delinquencies pick up, auto loan delinquencies pick up. And so I think there's reasons to believe that, trees don't grow to the sky and people can't do this forever.
There is all sort of a demographic theory that we're witnessing a wave of final spending by baby boomers on things that matter, like health care, right?
Yes.
And that's going to, at least in the next, say, 5 to 10 years, make getting to target more of an issue.
I think it's fair. You also saw a shift in spending, right? So, during COVID, it was a lot of goods people were buying. Now they're shifting to services, and you have revenge spending and travel spending and other things that will continue to prop that up as well.
So you say it's a credit picker's market because of all this. What does that mean?
So to me, if you go back over, and I say this a lot because I do below investment grade investing, and so to me, in the end of the day, the key to survival is to keep your default rate low. The yield's already high. I tell clients all the time, my job is to keep it, not give it back. And the reality is, for a long time, even if you made a mistake, you had the Fed would step in. COVID, as far as the market was concerned, we had a global pandemic that only lasted 2 weeks as far as the market was considered. And so I think now we're in a period where you cannot, as the Fed, support a market on one side and fight inflation on the other. Those are in direct contradiction with each other. I think the Fed has picked inflation. I think that fight is still ongoing, which means now you have to do your own homework. Those who are good at picking credits will keep a very high yield, and those who are not are going to give some of it back to defaults.